Hello and welcome to episode 312 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, welcome back to the show. How are we doing?
I'm really good. It's been an exciting week. One of the things to mention, probably from the off, is that 2 weeks ago I mentioned that I did a bit of moonlighting to appear on another podcast. The Financial Times asked me to appear on their podcast, and I told people to go and find it. Actually, it was only published this week. So if you go now, it's the current version of their weekly podcast that's out. So you'll hear me on that podcast talking about investing and giving tips for young people who want to get into investing, and more importantly, steer clear of the speculative CFD trading that we're hearing a lot about. So that's quite exciting. So if you want to hear that, I know there are quite a few listeners who do listen to the FT podcast and go over and download that. But yeah, it's been an exciting week, Andy. We've actually got Laura back on the show this week, haven't we? So Laura was on the show last week. She's making a return because there's an interesting development in the mortgage market. So no, all good. Actually, Andy, one thing I think we should do is ask for reviews before we kick off with the podcast. We always leave it till the end.
Yeah, absolutely. You know the deal by now. Popping on a review, it really helps us. We're going to make no apologies for asking you to do that. So head over to your podcast player of choice and pop a review on there. Obviously, iTunes is the one most people know about, but you can review the podcast in other ways, however you download your podcast. 5 stars is obviously a great place to start, and it means more people can see this show and download it.
And yeah, and if you do leave a review, there's a very good chance, especially if it's a nice one, that it will be read out on a future show. So let me kick off with what's on the show this week. I mentioned briefly there, Laura's coming back on the show to talk about an interesting development in the mortgage market. There's now a new product that's been launched. It's going to likely spur others. A 40-year fixed term mortgage. So something that's very innovative. We're exploring that. The other two pieces are closely related. I want to explore the idea of challenging some of your preconceived investment truths. And there are many out there that exist, particularly around asset allocation or the passives over active argument. I just want to explore some of that. And the final piece I want to do leads on from the FT podcast, interestingly, because I was asked to make a couple of book recommendations or resource recommendations. And we had a thread in our Facebook group, which was very interesting. So I've decided to pick a couple, 3 in fact, that are good resources, but also help challenge your thinking, whether you're a new investor or not.
So let's move straight on to the mortgage piece, and I'm going to welcome back our consumer credit editor, Laura. Laura, welcome back to the show.
Oh, great to be back.
That's 2 weeks in a row, Laura. You're starting to become a regular. This could almost be a podcast that we're going to have to say there are 3 hosts on, me, you and Andy. But
yeah, I'm more than happy with that. Yeah, it's just, good to have 2 weeks of, really interesting stories in my area, which is great. I'm not complaining.
So this week, Laura's back on the show because there has been quite an interesting development in the mortgage world. Now, it's relating to fixed-term mortgages. So I'm going to, rather than steal Laura's thunder, I'm going to hand over to her to explain what's actually happened.
Yeah, so we've had a new product launch this week from Habito, Habito One, and it's a 40-year mortgage. And the interesting thing about this one is that you can fix the rate for up to 40 years, which is quite revolutionary, actually. The longest alternative came from Virgin Money at the back end of last year, and that was only for 15 years. So this is something actually quite new and quite innovative.
So the key part of this product is that it's a fixed term product. So at the moment, the way that the mortgage market often works, that a lot of people will take out a fixed product for maybe 2 years, 5 years, up to 10 years, but typically 2 and 5. And then they will remortgage after that point if they don't want to go onto the lender's standard variable rate, which is at the higher interest rate that most people end up on. So this product from Habito, and I mean, if people don't know Habito, they are known for being a mortgage broker themselves. They're an online digital platform. If any of you had come to our live event, you would have probably seen them on the panel. So they are quite an innovative company and have launched various different products in the past, trying to change the mortgage market or try and help first-time buyers. Not all of them have proved as popular as they would have liked. But the key point of this product is the early repayment charges and exit fees, isn't it?
Yeah, as you say, you can fix the rate on this product for up to 40 years, but from day one, there are no exit fees charged. There is sort of a real great deal of flexibility with it. So I think people are either going to love or hate this product, really. For people who just want certainty, just want to be able to fix right at the beginning of taking out a mortgage or remortgaging, and they don't want to have to think every 2 to 5 years that they're going to have to remortgage, find another deal, pay another arrangement fee with a broker. They might really love this kind of product. On the other hand, you do run the risk that if rates stay low, you're going to be paying a premium for having this long-term fixed element. And yeah, so it's balancing those two things, really. So it's not going to be for everyone. You do pay a higher rate for being able to fix for that long, but actually it's not considerably higher than you would pay for shorter term fixed periods. And actually, if you think that over time, over the next 10, 20, 30, 40 years, the rates are likely to go up at some point quite significantly, there will come a point in the future where you could be saving quite considerable amounts.
So let's talk about some benchmark rates just to give people an idea. If we were to look comparatively against the market, where does this stack up in terms of the interest rate being paid? I mean, there's a lot more to think about when you take out a mortgage than just the headline interest rate. There's obviously the fees as well. But what are the interest rates that are on offer?
Yeah, so with this new product, obviously there's different rates depending on the loan to value. So it's starting at just under 3% for 60% LTV, but that's up to a 15-year mortgage term. If you're going for the full 40 years, for 60% LTV, it's 4.2%, and then it goes incrementally up to the highest rate, which is for 90% LTV for up to 40 years, and that's at 5.35%. And just to add, you've also got almost £2,000 arrangement fee for that product as well.
So there's a bit of margin in there, obviously, for them, because if people fix for the long term, like you said, this isn't going to change. And the other thing that was quite interesting that I noted is that the idea that this would be portable. So if you port a mortgage, it effectively means you can, when you move house, the mortgage comes with you as part of that move, so you don't have to get a new lender. But one of the things that, I mean, this is a very new product. There's a lot of detail that we don't really know as yet, but it'd be interesting to see what happens with that porting, because normally if you port a mortgage, it means that if you are going to buy a bigger house, then the additional borrowing that you need will have to come from that same mortgage provider. So that would be interesting, because porting mortgages is obviously a positive, but it does have its drawbacks as well, because you end up, if you want to use that, almost being tied to a particular lender and therefore their own underwriting and lending criteria. This is something that does occur elsewhere. Although this is innovative for the UK, the idea that you have a mortgage for your whole life, hence the name Habito One. I mean, I did think it was quite funny, actually, because they must have been kicking themselves about the idea of a lifetime mortgage, because lifetime mortgages obviously exist. They're a form of equity release. They couldn't call it a lifetime mortgage, even though that kind of feels like a name you'd use. But it does occur elsewhere, doesn't it? We do have this phenomenon in other countries.
Yeah, and I think that quite clearly they've drawn on some of the trends that we've seen in other countries. I think Japan is one, Germany is another one, where actually in Germany, the average term for a mortgage is 10 years. As a nation, they typically, well, I guess they favour that certainty over what the rate's going to be and what their monthly payments are going to be, over that kind of idea of trying to kind of beat the market, I guess, and beat the potential change in interest rate. So it would just be interesting to see whether it does actually line up with how people in this country approach things. I mean, it's interesting to see that really anecdotally brokers are telling me that those 10-year fixed rates aren't even really that popular at the moment, that people are tending not to want to fix for too long because there is uncertainty in the market, and there is, I guess, that feeling that rates are likely to stay low for a little while longer. People don't really want to fix for too long too soon.
So like you mentioned, I think Denmark and France have something similar. But I think that one of the interesting points out of this is the Bank of England. This is a bit of an open door for Habito. I mean, like I say, they're a broker, but they are acting as a lender in this instance. But having long-term fixes, the government would like that, because there is a point that if people don't have long-term fixes, when they change interest rates, that has a big knock-on effect into the economy. So if we all had very long-term fixes, they could move the Bank of England base rate with less impact on our own personal finances, because our mortgage rates wouldn't necessarily go up and down. I'm just looking at a couple of other bits here. At the moment, the loan-to-values on these things are between 60 and 90%, but they are looking to do a 95% version, aren't they?
Yeah, so I think a 95% LTV version is penciled in for later in the summer. Another thing to note is we haven't got a lot of the nitty-gritty details. We don't know about things like income limits or the age limits for taking out some of the longer term, sort of the 30, 40 year terms. I'm going to be digging into that a bit more. I'm writing a full review of this next week. So look out for that.
Yeah, so overall, we wanted to do a quick piece on the podcast about it, not necessarily because this product might be for anybody, but it's to allow people to realise that there is a change afoot in the mortgage market, that products are being launched. In fact, there is another firm that has said that they're looking to do a similar thing later this year. So I'm always a big advocate of getting advice when it comes to mortgages, because of the nuances involved in actually trying to secure a mortgage. It's a bit of an FYI if you're seeking advice, that there are these other products out there that could be appealing to you in terms of long-term fixes, because it removes the idea of defaulting on the lender's standard variable rates. It might suit your circumstances, particularly if you don't want to keep paying fees when you remortgaged further down the line. I mean, Habito are going to have to do a bit of work on this to prove the numbers, to sort of how they stack up over the longer term, because you are taking a bit of a bet, a bit of a gamble on where interest rates could be in a sort of 30, 40 year period. But of course, as Laura mentioned, there's nothing to stop you remortgaging at some point further down the line anyway if you took this product out. So it's something that's worth looking at if people are interested in FYI. But as ever, do make sure you get advice if you are wanting to take out a mortgage. So very interesting, something that's focused more on consumers. Right, on to the next piece, Andy.
Yeah, so you mentioned at the start of the podcast you're going to be doing a couple of bits that are themed around the same thing. We're going to start with the investing piece, and it's about challenging conventional thinking when it comes to investing. What do we got?
So the last couple of weeks in the investment world have been very interesting. So we've seen a bond sell-off. So we've seen yields rise in the investing world. And if you follow midweek markets, you'll have heard an explanation as to why. But very quickly, bond yields on government debt are rising, particularly in America, because of inflation expectations. Now, if inflation rises, that likely means that central banks put interest rates up. It means that investors buying government debt will want a higher yield. Bonds therefore do badly, typically in a very high inflationary environment, so they start to sell off as people move out of those into other assets, and in particular equities. That's a very simple, brief roundup as to what's been going on, but it's had a lot of knock-on effects. And I've had some interesting questions come in that relate to this period of time. So one of the questions I've had are people asking about asset allocation, and are we seeing the death of the 60-40 portfolio? So the conventional thinking is that a balanced, diversified portfolio starts with about 60% in equities and 40% in bonds. And the split varies depending on your appetite to risk. You can move it up and down. You might have 80% equities, 20% bonds. But at its core, this 60-40 split has been something that's been around in the investment world. And if you go and seek advice or you go and buy managed funds, it will likely be based around this concept of a 60% equity component versus 40% bond component. And like I say, variations thereof. And that's because if you go back over the history of fund management, if you go back 40 years, that split has been shown to perform well in terms of diversification and therefore provide a return and volatility, all that in the mix, well over that longer period of time. But in the last couple of weeks, what we've seen is that if you mapped a 60-40 portfolio, so it doesn't matter what it is, but if it's got a broad mix of 60% equities, 40% bonds, versus say an 80% equity portfolio with 20% bonds, or a 20% equity portfolio with an 80% bond segment, they've almost fallen in parallel. What usually happens in market sell-offs is you get the portfolio with the largest equity component tumble, where we're in a period where bond markets are tumbling, and that's where the epicenter of the trouble has started, because bonds yields are rising. That means bond prices are falling. It means all parts of the portfolio are almost falling in tandem. All ships are sinking as the tide goes out. And so for investors who might be thinking that they're invested cautiously, or they're trying to diversify their portfolios, they're seeing losses on their portfolios when they go in and check them. And they were wondering, well, does this mean the 60-40 split is over? And you will have seen headlines in the press talking very much around this topic. Is the 60-40 concept in danger of no longer working? Now, you have to throw out there that this is only a temporary move at the moment. We don't know whether we're going to get a continued increase in yields. What's really caused the problem of late is the rapid increase in yields. Not the fact that yields go up on bonds, but it's the rapid rate. So that's what's caused the sell-off, which has caused the panic. But what is interesting is to throw out there that the 60-40, this concept could be under threat. Now, if you think about the bond market has been in a 40-year bull market. So bonds have been doing well. They've effectively, the yields keep going lower and lower. And we're down at real historic lows or near them. And we've even got some government debt in Europe that is negative yielding. So it's actually got an interest rate, which means you effectively would have to pay to invest in that bond, which seems quite ludicrous. But that is what quantitative easing has done. That is what easy monetary policy has done. So if you think about it, we're at a point where yields are so low that the only way feels like it's going to be up over the long term. And if yields therefore do start to rise up and normalise in some way, and I mean, you've only got to think about the Bank of England base rate. If you just sort of visualise interest rates in an economy, they're so low that it does feel at some point the only way can be up. Now, if you accept that's the case, and therefore yields will start to push up, that means that we are facing a potential period of bonds underperforming, because if yields go up on bonds, the bond prices start to fall. If that does start to occur over the long term, then that would put under threat the idea of a 60-40 portfolio, because bonds wouldn't be able to, in real terms, diversify your portfolio. You almost would be guaranteed to lose money over the long term. And now we saw this back in the 70s. And if we have an inflationary environment that is sustained, that we have higher inflation that's allowed to remain at an elevated level by central banks, inflation doesn't necessarily mean good news for equities either. I mean, in time, it tends to, if companies can pass on price rises to consumers, then they should be able to try and maintain profits. Some companies find it easier to do that than others. But it does mean if what we've seen in the last couple of weeks becomes an entrenched move, then over time, that 60-40 idea could be under threat. Now, what is interesting is if that was the case, then something like a life strategy fund, which is very popular, the Vanguard Life Strategy Fund, would struggle in an environment where the diversification element is broadly equities versus bonds. Now, Vanguard are actually conscious of this. If you find it, we'll link to it. There is a piece in the FT that they wrote where they make a nod towards this idea of the death of the 60-40 portfolio. So the one message I want to people to throw out there is old views of diversification could start to change, and we might start to explore other asset classes. Now, that doesn't necessarily mean things like Bitcoin, but there are plenty of other asset classes that we are starting to be able to gain access to via things like ETFs, that portfolio construction starts to advance a bit more. It's not just 60-40. So what's been good over the last, say, 3 or 4 decades, it doesn't mean it will necessarily work in the future going forward, because we're in a very different world to what we were then. Back then, we've got quantitative easing and money printing now. That is one of the things I want people just to ponder. There's no answer to that, but it's just people start to ponder that they might have to think a bit more about diversification in the future than they did in the past. One other thing I want people to have a look at, this period, the last couple of weeks, has thrown up some interesting surprises in terms of nuances in equity markets. So technology stocks have been thumped, and that is because they're classed as a growth stock. So if you take a lot of technology stocks, a lot of the rewards, the potential profits that they're going to make are way off into the future. If the yields in the economy are higher, if interest rates are higher, if you discount those earnings back at a higher interest rate, that could possibly happen if inflation picks up, then what that means is the share price, which share price is just basically a discount of future earnings to all intents and purposes. That means a lower share price in today's money. The point being that it's not a good environment for technology stocks if we do see rising yields. So what it means is if in any element of your portfolio has exposure to technology stocks, it will have done badly in the last couple of weeks. So there's even been funds that I've reduced my exposure to in my portfolio that have done fantastically well over the last year. We're talking they're up almost double in the last year because of the exposure to technology stocks, but we're seeing a reversal of that trend, so they may be off. For example, one fund out there that has exposure to technology, a lot of exposure, is the Baillie Gifford Long-Term Global Growth Investment Fund. Now, broadly, that's down around about 20% in the last few weeks, but as I say, this fund has been, at the start of February, was almost up 100% in a year. But there's an interesting stablemate of this fund. So Baillie Gifford also have an investment trust called the Scottish Mortgage Investment Trust. It's not identical to the unit trust fund that I just mentioned, but it has a lot of similar holdings and it's really a technology play. And people generally have a conventional wisdom that if they had a choice, they would pick an investment trust over a unit trust. And that's partly because investment trusts can use leverage. So that means they can amplify the gains, which of course this investment trust has done over the last year. You can trade them daily. There's the ability to smooth income payments. So there's a lot of positives for investment trusts. And often unit trusts are seen as the sort of lesser cousin of investment trusts. But in the last couple of weeks, there's been pressure on the management of the Scottish Mortgage Investment Trust to disclose what's going on with the top 10 holdings. And that's because that fund has fallen about 30% in the last couple of weeks, so giving up some of those huge gains over the last year. And it's likely that part of that is down to the leverage that you get in investment trusts. So again, what we've seen in the last couple of weeks is a conventional wisdom being challenged that investment trusts are generally better than in unit trusts. It's something that I often see written in forums and online. But we're in an environment where the very things that set apart investment trusts from unit trusts are actually hampering and hurting investors' portfolios. The other thing is growth stocks, so growth versus value. Now, in recent history, we've seen growth stocks massively outperform value stocks, so the unloved sectors out there and the unloved companies. And so growth stocks often are the likes of Facebook and Apple, the technology stocks. But what we've seen in the last few weeks, and it's the trend that really started before Christmas, is that value stocks started to outperform growth. And that rotation from growth into value has picked up steam. And are we about to see a period now where we're going to finally see value investing outperform? Because value investing has largely lagged other styles of investing in recent history because easy money from central banks has just flooded the stock market, which is that ultimately ended up in growth stocks because interest rates have been incredibly low and it's kept fueling that desire for growth stocks. So are we about to see another truth that we've become used to about owning these big tech giants, owning these growth plays, and that value has had its day? The likes of Buffett, you often see that people saying that Warren Buffett is washed up, he's a famous value investor. Are we about to see that change? And the other point I want to bring up before I move on is that the idea that the only way to invest sensibly is via passives. Now, if we see a continued trend, I mean, what I'm talking about has only been something that's been going on for probably a bit more than 2 weeks, about a month. But if we get into an environment where this at some point starts to continue and become entrenched, it doesn't have to be now. It could be something that happens in a few years' time. I'm just floating the idea. If we see technology stocks massively underperform for an extended period of time, because at the moment, other areas of the market are doing quite well. For example, the Dow Jones has been doing very well over the last couple of weeks, despite the fact that technology stocks entered a correction. If we see that divergence, passive investors buying trackers, say, for example, in the S&P 500, will start to see their returns hit because a lot of the big indices around the world, not the FTSE 100, but a lot of the big indices like the S&P 500 have huge exposure to growth stocks. And if those growth stocks and those technology plays in particular start to underperform, then we could start to see passive investing start to lag. Because in the recent couple of weeks, there'll be many passive investors who will be looking at their portfolios and they will have underperformed. And there have been a number of active managers who have started to outperform because they are investing in value. That's not like an overarching trend, but there is definite pain being felt by those investing in passives. Now, of course, if you invest over the long term, these things hopefully will iron themselves out. But it is interesting that when you have a period that we've had recently, it just highlights, like I say, some of the conventional truths that people hang on to, that yes, bonds and equities are one of the best ways to diversify a portfolio. Conventional portfolio construction will work in the future. That investment trusts and ETFs are always the best way to hold funds. That passive investing is the only way forward. Invest in technology, all these things. So just something to bear in mind, an interesting concept. But then I want to lead on to my next piece, which hopefully will start to challenge some other people's conventional thinking around investing, because I always try to challenge my own and try to read more around different things to try and avoid slipping into those lazy assumptions that can impact my own investing. And it comes off the back of the FT podcast, actually, because if you listen to that podcast, I'm asked for 2 book recommendations and resources that people can go and look at. And I named 2 books in there. I mean, one of them was The Naked Trader by Robbie Burns, which is all about investing in shares directly. It's a very good book. And the other one was How to Own the World by Andrew Craig. Now, the second book in particular is quite interesting because it's a very good book if you're starting out in investing and want to learn a bit more, but it does throw up the idea of gold. He does like gold in that book. So if you don't like gold, it's worth reading that book because it will start to introduce some of the positives around gold. Gold is one of those things, it's like Marmite. People either love it or hate it. There's very few assets that diversify the investing world as much as gold. But it's quite a practical book. But I want to give a couple of other books that I think it would be worth people reading as well, because I'm always asked what my favorite books. I don't like to say what my favorites are. I tend to try and read lots of books, but one of them, The Behavioral Investor by Daniel Crosby. Now, it's not one I've seen lots of people talk about, but it's split into 4 parts, but it has a lot about behavioral finance, psychology, and understanding and managing yourself emotionally to be a successful investor. Now, the other thing it talks about is like the importance of intuition, and it also looks at multiple styles of investing. Now, what tends to happen with a lot of investment books is they beat the drum for one style of investing. Often it's just for passive investing. Occasionally it might be value investing, for example. There's a lot of famous old books. I wanted to try and steer clear of some of the old well-known books and look at some of the more modern literature that's out there, because markets do change. And he looks at various styles of investing, and he does look beyond the whole passive and active debate. And what he does, he ultimately starts to formulate a rule-based style of investing. Now, rule-based investing is where you, quite as the name says, have rules that start to make you a better investor, whether it's you may reduce your equity exposure if markets do a certain thing, perhaps an index falls below its 200-day moving average or something like that. It's a very interesting book, and I think it broadens people's horizons, helps them understand why markets behave like they do, or why they in particular behave in a certain way when markets do things, why they get scared, how to overcome these things. But it makes you very objective. And of course, 80/20 Investor is really effectively almost a rules-based style of investing in its own right anyway. So that's one book. Another one is Investing to Save the Planet by Alice Ross. We did a live event not long ago, which we'll link to in the show notes, which was all about green investing. But I know there are a lot of people out there who think that investing ethically and investing to save the planet will hit returns. There's not much opportunity to do so. Now, the book's interesting because it actually makes you move more towards the active investing end, partly because active investing is where most of the ethical opportunities lie, because it's difficult to invest ethically with a passive investment because you buy the S&P 500. There's obviously a whole load of companies in it. So you tend to have a manager choosing and picking and using the criteria, but also about becoming active in the companies that you invest in and trying to drive change that way. So that's an interesting book. But the other one I wanted to throw out there is not so much about investing, but it's also about managing money and retiring early. Now, Choose FI by Chris Mamula, Brad Barrett, and Jonathan Mendoza. They actually have a podcast, Choose FI. And it was a book that I quite enjoyed when I read it. I know there are a lot of people who are very dismissive of the FI movement, so the financial independence movement. It's normally called FIRE, Financial Independence, Retire Early. My view is that it's built on a lot of sound financial planning, but it gets a bit extreme with the people you see in the national press who are going to retire early because they live on baked beans. They don't really represent most of that community or the people who follow it. This book was actually one that covers a broad range of topics within it, but there's a lot of sensible money stuff in it. Even if you don't believe in FI and you don't really want to go down that road, this is probably the most balanced account I've read of it, and it has a lot of common sense in investing. One of the things, for example, which I quite like about the book, and it goes back to something we've talked about in the podcast, there are a lot of ways to make money. You don't have to invest. You can invest in yourself. You can build a business. There are people out there who do buy to let. So it covers a broad range. The investing part is very limited in it, but the concept around about what you're trying to achieve in financial independence is quite interesting. And again, it's a bit of a Marmite issue. There are people who are really into it, and there's people out there who don't really buy into any of it. But it's worth a read or listening to the audiobook of it, because it will challenge some of the ideas that you have, but also it will probably spark one or two interesting ideas in your own head. So there you go, Andy. In a week where I think we've all been challenging a lot of our own preconceived ideas about a lot of topics in life, I hope that this week people will be looking at a lot of the ideas they have on money and investing.
Okay, so that's it for this week. If you want to get in touch with Damien, you can do so. It's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with the number 2. Don't forget the Facebook group as well. It's facebook.com/groups/money-to-the-masses. We don't mention it every week in the podcast, but it's worth mentioning. We do have a YouTube channel. We've got thousands of subscribers on that YouTube channel. So if you are someone who goes onto YouTube to consume various bits and pieces, why don't you just subscribe to our channel? Because again, that would really help us. So just head over onto YouTube, type in Money to the Masses, and you'll find our channel.
So great stuff. Thank you to Laura again for being on the show. I know you all enjoy hearing more voices than just mine and Andy's. So all that's left is for us to say until next time.
Until next time.